Imagine you're sitting in a cafe, quietly sipping your coffee on a Saturday morning. Next to you, two people are talking about investments. One boasts, "I buy and sell stocks every day, spend hours following the market, and yesterday I made $200 on a single trade." The other smiles and says, "I don't do anything. My money works for itself, and in the long run, I'll probably make a lot more than you." That second person practices what's called passive investing. And while it sounds boring compared to the adrenaline rush of constant buying and selling, it's one of the most powerful, safe, and effective strategies available for creating real wealth. Today, in this video, we're going to discover together what passive investing means, how it works, why it can be your best ally if you don't want to complicate things with the stock market, and above all, how you can apply it in your own life, even if you know nothing about finance. Chapter 1. What does passive investing mean? When we talk about passive investing, we're talking about a simple strategy. Instead of trying to guess which stock will go up or down tomorrow, you invest in the entire market for the long term and let time do the work. Think of a river. An active investor swims against the current, fights each wave, gets tired, sometimes advances and other times retreats. A passive investor, on the other hand, gets in a boat and lets the current carry him. He doesn't fight the market. He goes with it. In practice, passive investing means putting your money into index funds or ETFs that track major indices, such as the S&P 500 in the United States or the MSCI World Index globally. It's like buying a small portion of the world's 500 largest companies, rather than betting everything on a single company. Chapter 2. The origin of passive investing. This concept didn't always exist. In the 1970s, a man named John Bogle, founder of Vanguard, launched the first index fund for small investors. At the time, he was ridiculed. They said no one would want to settle for the market average. But over time, the results spoke for themselves. While thousands of active managers failed to outperform the market, passive investing generated stable returns, with less risk and very low fees. Today, trillions of dollars are managed passively. What once seemed mediocre is now the favored strategy of many experts, including Warren Buffett and Nobel Prize-winning economists. Chapter 3. Practical example. The impatient versus the patient. Investor. Imagine two friends, Anna and Jorge. Anna decides to invest actively. She buys shares of Tesla and Apple, trying to guess when to sell. She spends hours watching the news, and every market move stresses her out. Sometimes she wins, but other times she loses a lot. Jorge, on the other hand, simply buys an S&P 500 index fund, holds it year after year, and doesn't worry. After 20 years, who wins? Statistics show that more than 80% of active investors lose out to passive investors over the long term. Anna may have her moments of glory, but Jorge ends up with more money, less stress, and more time to enjoy life. This is the essence of passive investing, betting on the long term without trying to outsmart the market. Chapter 4. Advantages and disadvantages. Advantages: low cost, very low fees, which means more money stays with you. Automatic diversification. By investing in an index, you own pieces of hundreds or thousands of companies. Less stress. You don't have to guess the future or constantly follow the news. Proven results. History shows it works over the long term. Disadvantages: less excitement. You won't have epic, "I got rich in one day" stories. It depends on your patience. It requires discipline and not selling during crises. It's not always immediate. It's a marathon, not a 100-meter dash. But if you think about it, those disadvantages are precisely what makes it so effective. You don't need to be a financial genius. Just have patience. Chapter 5. How to get started. Step by step. Let's say you've never invested before. What should you do? Open an account with a reliable broker. For example, Interactive brokers, DeGiro, Vanguard, depending on your country. Choose an index fund or ETF. Examples: S&P 500 ETF, SPY-VOO, MSCI World, IWDA. Fixed income funds if you want to diversify. Set a monthly amount. It doesn't matter if it's €50, €100 or more. The important thing is consistency. Automate, schedule monthly purchases. Don't think about the market. Hold for the long term. Forget about selling at the first dip. For example, if you invest $200 a month in an index fund with an average annual return of 7%, in 30 years you'll have more than $200,000 thanks to compound interest. That's the magic of letting time do its work. Chapter 6. Common mistakes and how to avoid them. Typical mistakes: giving up during a crisis, selling cheap out of fear, trying to mix passive investing with crazy bets, putting all your money in at once without diversifying over time, thinking short term. Remember, passive investing isn't sexy, but it works. It's like a healthy diet. You don't see results in one day, but with consistency, the results are impressive. Conclusion: if you've ever felt intimidated by the world of investing, the good news is this: you don't need to be an expert, predict the future, or live glued to a screen. You just need discipline, patience, and a simple strategy. Passive investing is like planting a tree. You plant the seed today, water it a little tomorrow, and in a few years, you'll enjoy the shade and the fruit. The best time to start was yesterday. The second best time is today. If you liked the video, give it a like and subscribe so you don't miss any videos about the economy and personal finances.